Hi guys, I hope everyone's doing really well. My name is Sourabh Mutha and I'm part of the Yeshas team on Unacademy. Yeshas has been trying to simplify lives for CA Inter as well as CA Final students by bringing a host of courses. This is a very short video, a 15-minute video for CA Inter students for tax. This one simplifies a chapter called IFHP. In 15 minutes, I will show you two complicated topics. That is, one is vacancy loss. What exactly do you do with vacancy loss? And second, when a house is part of the year let out and part of the year self-occupied, what do you do with that? I'm going to do two ICI module questions also on that. But before we start anything, let me tell you what Yeshas and Unacademy are doing to help you simplify life at CA Inter. We've already started and we've already completed a fast track course for CA Inter students, and this basically it covers everything that you need to do. Personally, I've completed tax, and if you enjoy my video and if you enjoy the shortcuts that I give you in this video, you should definitely watch my tax CA Inter fast track course. Besides this, if you use the code YESHAS, you can get a host of other benefits, including other top educators, and use the code YESHAS to get multiple more benefits. These are the educators on Unacademy, which you can access once you subscribe. Over to the topic for the day. I've always felt that IFHP is a really important chapter, and at CA Inter, one question on IFHP, income from house properties, always there in the exam. But in that, I'm looking at a topic called vacancy loss. A lot of people don't understand vacancy loss. A lot of people don't know how to calculate and when to subtract vacancy loss. I'm going to give you a very nice shortcut for that. But let's take an example. Let's say you have a house property which is constructed, which is built completely, and you've given it on rent for 1 lakh rupees a month. But the person used the house property only for 10 months, and after that, no one stayed in the house. And only then it's called vacancy. If you go and stay in the house as self-occupied, then it's not vacancy. So basically, it was 2 months, no one, not even you, not even the tenant, no one was staying. So 2 months was vacant. Is that something that bothers you? Of course, vacancy leads to a loss actually, because no one's occupying the house. So it's small loss to you because 2 months it was completely vacant. Now let's try and understand how vacancy loss works. We will do a quick question on this. Let's see how this works. Now, the moment this house is let out house property, LOP, they want to compare your actual rent, that means whatever you are saying, with the expected rent or the reasonable lettable value which the government feels you should get from this house. They compare the fair value, the municipal value, and they say that it should not be more than the standard rent. So let's say the fair value of this house, that is fair rent of this house, is 80. The municipal value is 90, and let's say the standard rent is 85. No, let's say it's 95. 1 second. Let's say it is 95,000. Now you will basically compare fair rent and municipal value and take higher of the two, that is 90,000. And that 90,000 should not be more than the standard rent. Yes, it is not more than standard rent. So 90,000 it is. So 90,000 into 10 into 12 is equal to 10,80,000 is what the government is expecting you to earn from this house property as gross annual value. Now you'll be wondering, do I minus unrealized rent from this? If there is unrealized rent, do I minus vacancy loss from this? No, the government doesn't care about all of these things. The government says that if you have a house, we are expecting this to be the GAV. At least we are expecting this to be the GAV. So they don't care about your unrealized rent. No, they don't care about an unrealized rent. They don't care about your vacancy loss. No. So always remember, guys, they will calculate for the entire year. Actually, assuming you have the house for the entire year, they will calculate for the entire 12 months. And they will say that this is what I'm expecting to earn. They will not look at unrealized rent. They will not look at vacancy loss. Will you look at vacancy loss? No. Initially, guys, you ignore vacancy loss. So you don't pay attention to vacancy loss at all. So your actual rent is 1 lakh rupees into 12 months. But 2 months it was vacant, right? Yes, but you have to ignore vacancy loss. So you basically have to ignore, when you start calculating it, you ignore vacancy loss. So 1 lakh into the whole year, so that is 12 lakh rupees. Now, is there any unrealized rent? If you want, you can minus unrealized rent. Guys, unrealized rent is like a bad debt. In your business, if you sell goods to someone and they don't pay you, is that a bad debt allowed as a reduction? Yes, same way. Unrealized rent, you give a tenant a house and he does not pay you. And as long as it fulfills 4 conditions, you can minus unrealized rent. So you can minus unrealized rent from this, yes. But unrealized rent in our example was nothing. So I'm just going to put 12 lakh rupees. This is my actual rent and this is my expected rent. Still now, I have completely ignored vacancy loss at both ends. Even expected rent, of course, they don't consider vacancy loss. And even here, I have ignored vacancy loss. So step one is you calculate it normally and ignore vacancy loss. Step two, only if your AR is more than your ER. Only if your AR is more than your ER, only then you minus vacancy loss. So that's a shortcut. So let's see in our example, is your AR more than your ER? Yes. Your AR is 12 lakhs, which is greater than 10 lakh 80,000. So yes, your AR is more, and only if your AR is more, which is our condition, only if your AR is more than AR, then you minus vacancy loss. So please tell me, for how many months was it vacant? 2 months. What is the last trend before that you were earning 1 lakh rupees a month? So what is the vacancy loss? 2 lakhs. You minus that and you get 10 lakhs, and that is your GAV. By the way, the moment your actual rent is more than your expected rent, you ignore your expected rent after that. So now your GAV is 10 lakhs. You will do municipal taxes minus. You will get NAV from that. You will minus 24A, the 30% flat deduction. Then you will minus interest deduction, and you'll get your income from house property. Again, I repeat, what is the first step in case of vacancy loss? The first step is you ignore vacancy loss. Ignore vacancy loss at both ends. Your ER also, you never look at vacancy loss anyway, and your AR also, you ignore vacancy loss. Any unrealized rent you can minus, but vacancy loss you ignore. What is step two? Only if your AR is greater than ER, only then you go to step three, which is your AR minus the vacancy loss. And then you don't look at ER, even if it's lower, like in our example, it was lower than your ER, even then you don't matter, because the moment you win, you have to ignore ER completely. That, my friends, is an example on vacancy loss. I'm going to show you a sum from the module. I'm just going to open up to a module question. Let's have a look at one module question for this. Just a second. Give me a second. I'll open up the module for you guys. Very important to do module questions, and these module questions really go a long way because they're really important from the exam perspective. So just putting up a module question on the screen right away. Perfect. This is the module. Let's look at a module question. I also remember that question. It is somewhere here. Perfect. Guys, this is the question. Let's have a look at it. Ganesh has a property whose municipal valuation is 2,50,000. So municipal valuation is 2,50,000 per annum. The fair rent is 2 lakh rupees. Higher of the two right now is municipal value. And the standard rent is 2,10,000. So although municipal value is high, it can never be more than the standard rent. So your expected rent, we've already got an answer. Your expected rent is 2,10,000. Keep it parked. No impact. Unrealized rent will not impact it. Vacancy loss will not impact it. The property was let out for 20,000 per month. So your actual rent is 20,000 into 12, which is 2,40,000. If there's any unrealized rent, minus it, guys. However, the tenant vacated the property in January. Ignore vacancy loss right now. So although you know vacancies for 2 months, February and March, ignore it. Unrealized rent was 20,000. So from this, you minus 20,000. So I'm minusing 20,000 from this, which becomes 2,20,000. So what have I done? Step one, I have calculated AR and ER. In AR, I can minus unrealized rent, but I have to ignore vacancy loss right now. And now tell me, guys, is your AR greater than ER? Is your AR, that is 2,20,000, is it greater than ER? Yes, it is. Then you ignore ER and you take AR, that is 2,20,000, and you can minus vacancy loss. How much is the vacancy loss? Vacancy loss is for 2 months. So last rent was 20,000 into 2, that is 40,000. And that's for how you get your GAV of 1,80,000. This is it, guys. Here is your GAV. GAV is 1,80,000. So don't get confused ever. From now onwards, whenever you see vacancy loss, step one is you completely ignore vacancy loss, calculate AR and ER. In AR, you can minus unrealized rent, but in ER, don't do anything of that sort. And once AR is greater than ER, then you completely ignore ER and minus vacancy loss happily to get your GAV. That is the first concept that I wanted to discuss. The second concept that I wanted to discuss is, I'm just going to take a new sheet. We will also do the same way. Guys, just small shortcuts. My DT entire lessons, whether they're offline or online or Unacademy or anywhere else, are full of these kind of shortcuts. Yeshas and Unacademy have tied up to simplify life for you, just like I've done for you right now. The next concept is when you have an income from house property. So you basically have a house property. You let it out for 9 months. So 9 months, and let's say you let it out for 1 lakh rupees. So you earn 9 lakh rupees from it. But then somehow you like the house too much and you wanted to go and stay in the house. So you also stayed in that house for the next 3 months. This is a typical question in your exam. And this, some people think, oh, after 9 months it was vacant. No, there is no vacancy loss here. Why is there no vacancy loss? Because where is the house empty? So house is always occupied by someone. So there is no vacancy loss. The entire 12 months, the house is occupied. So no vacancy loss. Now in this case, how do you do? I'll give you a shortcut, guys. Whenever a house is LOP for part of the year and SOP for part of the year, you have to just calculate it the same way as LOP. My students already know the shortcut. LOP plus SOP is equal to LOP. That means, guys, a part of the year, if you are let out and part of the year it was self-occupied, you calculate the same way as let out property. So let's see what is the calculation. What do you do for LOP? For LOP, I'll do it here only. For LOP, the calculation is very simple. You take your actual rent and you compare your expected rent. Let's say the expected rent, I'm just taking random values. The fair rent is, let's say, 10 lakh rupees. The municipal value is 10 lakh 50. And the standard rent is 11 lakh. So you'll take higher of fair rent and municipal value. So you'll take 10 lakh 50. So you've got expected rent, which is not my worry. My thing is, how do you calculate actual rent? In actual rent, for 9 months, you got 1 lakh rupees. So people say 9 lakhs is my actual rent, but that is not right because you are comparing 9 months with 12 months. So you also have to put 3 months into 0. Why 0? Because you are using it yourself. So that is 0. So hence I get 9 lakh. Although the answer will still be the same, but your understanding has to be right, guys, that 12 months has to be, AR has to be for 12 months. Because your even AR is 12 months. So both have to be for 12 months. This is 9 lakh, this is 10 lakh 50, AR is 9 lakh, ER is 10 lakh 50. So which one do you take? You take ER. So that becomes your GAV. So your GAV here is 10 lakh 50,000. Just by the way, what have we done here? First, I have told you that LOP plus SOP is equal to LOP. This is not a vacancy loss because someone is occupying it. It's not vacant completely. And in this calculation, you're comparing your AR and ER, so both have to be taken for 12 months. The time that you occupied yourself has to be multiplied by 0. So this is also 12 months, this is also 12 months. Now just extending the concept, if there was a vacancy loss here, let's say there was some vacancy loss, maybe you occupied it for 2 months and 1 month there was vacancy loss. Can I minus vacancy loss? No, because your AR is not greater than your ER. So how? I'm just combining the two concepts. Let's look at a module sum on just this same concept. Looking at a module sum on just the same concept. Just a second. There's a question here. Yes, Rajalakshmi. Let's have a look at this question. Let's finish this question. So there are two concepts. Complicated concepts are done and dusted. This is Srimati Rajalakshmi. Just 1 second. Perfect. Owns a house property in Chennai. The municipal value of the property is 5 lakh. So they're talking about municipal value is 5 lakh. Fair rent is 4 lakh 20. So municipal value is higher here. And standard rent is 4 lakh 80. So basically it's 4 lakh 20 or 5 lakh, whichever is higher. So 5 lakh is higher, but you cannot be more than standard rent. So your expected rent is 4 lakh 80,000. I'm just putting in a box because this is ready. Now the property was let out for 50,000 per month up to December 2020. So it was let out LOP for up to December. So 9 months into 50,000, that is 4,50,000. Thereafter, the tenant vacated the property and she used the house as self-occupation. So basically it was never vacant. So there is no vacancy. So your AR for 12 months is 4,50,000. And your ER for 12 months, always compare 12 months. A lot of people feel, no, we should compare 9 months. No, always compare 12 months. 12 months. This is what is your actual actual rent. But there's something more, guys. Let's finish that also. So it is 4,50,000. Now, rents for the month of November and December could not be realized in spite of the owner's efforts. All the conditions prescribed have been satisfied. Guys, if there is any unrealized rent, can be minus that. Unrealized rent is always allowed to be minus as long as there are 4 small conditions which you fulfill. Most exam questions will fulfill that. And unrealized rent is like bad debts, you can minus it. So for 2 months, they have not paid. Basically, so 2 months into 50,000, they've not paid. So 1 lakh rupees they've not paid. So your actual rent becomes 3,50,000. Now, guys, if there was any vacancy loss, it's not there, but if there was, you could not minus it because the AR is not more than your ER. And now your GAV is 4,80,000. Very, very simple. If you understand it conceptually, it's a very, very simple concept. I hope you understood this. Guys, our lectures, the entire Yeshus team, and not just me. My name is Sourabh Mutha, but the entire Yeshus team tries their best to simplify concepts for you. We revise, we re-revise concepts. We again do them in the fast track course and tax marathons. So we ensure that you clear exams really well with us. If you have any comments, suggestions, anything you want to reach out, you can always reach out the team. Subscribe to Unacademy. The entire Yeshus team is eagerly waiting to teach you. Thank you so much.